I wanted to cover the Feb 2026 update. Uh, what does investing look like in the current stage of the Indian markets? It has been a very dicey journey, and I think I wanted to focus on a few pointers which I have listed here, which is where are the Nifty valuations currently? What does the overall Indian economy's liquidity look like? What is the interest rate likely scenarios? What is the geopolitical situation at this point? What are some of the undervalued sectors and how can one invest into that? And what is my watch list at this moment uh, in comparison to point one covering Nifty valuations? Now, if you look at this chart, this is the Nifty's price to earnings chart with the dotted line showing you the historical median since the time Nifty was active. And if we see the Nifty valuations are above that line at this point, that in itself tells me very clearly that Nifty is even slightly, but is overvalued. What that indicates to me is that this is not a situation or this is not a level where I should be making fresh investments, irrespective of how strong the fundamentals look for a particular company. Yes, I could be challenged. Yes, there could be other methods of investing, but this is what I have been following and this is what has worked best for me. If we look at the system liquidity, and you can find this chart on TradingView for any country that you wish to look at, but if you look at the system liquidity, the Indian central banking balance sheet is expanding. What that means is that the Reserve Bank of India is buying back the bonds, the government bonds from the market participants and pushing that much cash into the system so that that liquidity gets picked up by various entities, banks and lines of credits, and the credit cycle can become much more robust. There is one slight threat to this system liquidity at this point, which is the rise of the crude oil prices. Now, the reason these two are interrelated is because if the crude oil prices increases, what that is going to do is push up the inflation. And if I have to say, the inflation caused as input cost because the crude oil was an input cost to certain businesses. And also, crude oil is going directly as a cost to our energy requirements. And thus, consumers also might be hit because of that. Now, the moment the RBI is going to envision that the inflation is going to shoot up, that's where they will be forced to bring this system liquidity out of the system once again by selling the bonds that they are holding today. That's a threat at this point. How much will it materialize? We cannot say at this point. It is very difficult to judge from the juncture that we are at this point. But as of now, as of this number is as of December, or rather as of Jan 1st, the situations on liquidity look very promising for the economy to continue to grow. Interest rates are at 5.25, and this also largely depends on what the geopolitical situation is, and this largely depends on where the crude oil prices go and how well does the inflation turn out for us. If the inflation continues to be on its steady path, hovering around that 4% level, even going below the 4% level, we might see the interest rates to be reduced. But that is a very unlikely scenario at this point. We are not even close to thinking about that with so much going on in the world at this point. On geopolitics, we have two things going on. One, there are global wars ongoing where certain countries are attacking certain countries in the West Asia, certain Western countries are attacking uh, the countries holding oil or countries who are holding oil and planning to sell them to the Chinese economy in Chinese yuan, and then there is a lot of um, give and take around that. So all these attacks that are happening on these countries for natural resources are eventually going to lead to inflation, and that is a very concerning point. At least as of February 2026, we can see what would exactly pan out maybe a month later and see if it improves or not. That also will give us a lot of confidence on whether the markets are ready to stabilize and move on, or are they still going to be in a meek area. The second thing that is happening on geopolitics is US is trying to keep extreme dominance of the dollar in the global trade, right? Because what most countries are trying to do is, if I am dealing in Indian rupees and another country is dealing in, let's say, the Russian ruble, the two countries want to trade in their own currencies. Now, there is nothing wrong with that. But the problem is it's changing the way the world trades as compared to what it was for the past 40 or 50 odd years, where everyone traded in one currency, which is the United States dollars. Now, if this situation is changing, then definitely US is going to try and muscle its way through trying to see how the US dominance could be kept in check and how the other countries could be facing heavy penalties if they are not supporting the US dollar trade, which is what you are seeing in the forms of tariffs, in the forms of policies that are absolutely not friendly for the developing nations to continue developing, right? That's where we are at this point. So geopolitics is going to play a very important role. Now, some of the undervalued sectors, what I have seen, and you are seeing the same logic that we apply to Nifty, the same logic applies here. The median line is a dotted line. Anything below that, we are saying we are in the undervalued zone. So I'm seeing Nifty FMCG is an undervaluation, Nifty IT is an undervaluation. Same goes for Nifty Pharma, Nifty Financial sector. Mind you, when I'm saying financial sector, it does not mean Bank Nifty. There is an index specific for Nifty Financial sector. And then there are two more, Nifty Realty and Nifty Infrastructure, which are also in a very minor way undervalued. Nifty Realty, I wouldn't even call it undervalued at this point, just because of the chart it is undervalued. But if it dips a lot more, then that would bring Realty into a clear undervaluation. Now, how do you make use of this undervaluation data? Each of the sectors that I was showing has a related ETF associated with it. So you can take exposure to a Nifty Realty ETF by buying that ETF and saying that this is my way of taking exposure to the Nifty Realty Index, which is undervalued at this point. So it could lead to good opportunities. That's how personally I invest. I look to take exposures via ETFs in sectors that are undervalued. Uh, and I have still not I've still not gone through a phase of having exposures to ETFs and the markets turning bullish. So I don't know how that is going to work out, but that's an experiment that I'm trying to do with the kind of investing that I do. I'm trying to make uh, at least a large part of investing with less, less effort and less things to manage. So let's see how this turns out. But every single index, you name the index, and there is an ETF available for it now in the Indian markets, which was not the case 10 years ago. So that's a very big blessing that we have that we can utilize. Now, this is my watch list. I've only put a few sample stocks here, but I have around 14 more stocks apart from these. But I've kept my analysis very simple. The stocks that are fundamentally strong, no doubts about that. Stocks that have a valuation closer or lower than Nifty. Nifty is right now around 21.5 or 21 broadly. So all these stocks have a valuation of less than 21x. And I'm looking at only those stocks which have a market capitalization greater than 10,000. At this point, I'm not interested to take positions on small caps because in such a market, small caps going down may take years to recover back to where they are supposed to be. And assuming that I am anticipating fresh FII investment to come into India this and the next year, if things improve, of course, then I definitely see those FIs to first take exposures on the large companies so that they are starting again to build a fair and good portfolio and then go towards building uh, small caps and mid caps. And that's why if you broadly see the large caps recover very quickly after market has fallen and the small and mid caps take a lot of time to come back up. The reason for that is FIs are not exposing themselves immediately to mid and small caps. They do that as in the last leg of the recovery. So that's broadly what the update is. I'm going to try and keep a similar update once the month of March ends, and then we'll see where the Nifty valuations are, what sectors do we have in undervaluation, uh, what is the yield looking like. I'll try and cover some of the bond markets also and why at this point, at least at the very current juncture or at to this state, it is why is it better to hold your investment in debt instruments like bonds over an equity market. That's all from me for today. I hope this was insightful. Thank you.